Goldman Sachs Investment Chief says that the crypto bubble will burst and that it will affect 1% of the global GDP. At the same time, Deutsche Bank is blaming the recent U.S. tax reforms for their net loss of about $2.7 billion in the fourth quarter of 2017, which happens to be their third consecutive annual loss. So how much is 1% of the global GDP? Could 1% turn into 10%? And if there's a bigger issue in the financial system, what will happen when the EU places their 48 largest banks under a stress test? Let's discuss. Hey everybody, I'm Gary Palmer Jr., you're you, and together we are Minting Coins, your trusted source for crypto news, interviews, and ICO reviews. Thank you for showing up. Hit that like button. It really supports us and it helps other people find this content. Also, if you have any questions or comments, leave those in the comments box below so your voice is heard as part of the community. In today's episode, we're going to be talking about some recent news coming from Goldman Sachs, some recent news coming out of Deutsche Bank. Goldman Sachs talking about how crypto is going to burst, how it will affect the global GDP, bringing the economy down. And so with the speculation of their analysis into Bitcoin and the coming crash of Bitcoin, on top of other recent news from Deutsche Bank having to realize all of these losses and then blaming the US tax policies, well, there's a lot of information that isn't adding up. We know a lot of new money is being printed in the world, and a lot of people are recognizing that there may be a correction in the economy, and when that correction happens, then there may be a shift toward cryptocurrencies. There could be a pivot toward tokens like Bitcoin, Ethereum, and other decentralized open source blockchain technologies. This has happened in 2008, this has happened in 2000, this has happened in 1984, this happens every few years it seems. And the difference is that in 2008, this was a huge problem. The banks crashed the economy, there were no consequences for the banks, and people were dismayed, they were upset, they wanted to see change, and change was not actualized. Instead of change being made, what happened is that a completely new system started to be built. And so when this crash happens again, because we live in a market and the market has ups, the market has downs, now Bitcoin is going to be a new variable that the banks have never had to deal with before. Now they have dealt with the dot-com crash, the internet was a fad, there was a dot-com crash, and all of these companies were becoming practically worthless. But in that point, in the moment of desperation when everyone was selling all of those dot-com stocks, and granted some of those projects failed spectacularly, the banks swooped in, they purchased Microsoft stock, they purchased Amazon stock, they purchased Apple stock, they purchased companies that were innovating in the space, companies that were moving forward because Wall Street recognized that the future was computers, the future was information technology. And once there was this huge crash, companies, corporations, banks were able to come in and make incredible deals purchasing the stocks of these companies at incredibly low levels. And so could we see a similar playbook? Could we see a larger systemic economic downturn, partially blamed on crypto, partially blamed on the economy overall? Could that be coinciding with a crash in crypto? And then will that subsequent crash, events following the crash, will that lead to an incredible boom in and around blockchain technology? There's a lot to review. Let's take a peek at the news and then let's discuss. So starting over here at Cointelegraph.com, we have this one article that says the Goldman Sachs Investment Chief says that the crypto bubble will burst, affecting 1% of the global GDP. And what she says is that cryptocurrencies in their current format are in a bubble. And so this person, she guides investment strategy for clients with over $10 million in assets, and cryptocurrencies, she says, are a hot topic among her clients and colleagues. And she's letting them know that that they're currently in a bubble, that there's huge risk involved, and that they're going to cause the world GDP to drop by at least 1%. So what Mossavar-Rahmani argues is that the topics and NASDAQ look like a flat tire compared to crypto, and even compared to the infamous tulip bubble in the early 1600s. She says that the Bitcoin's price is just too high, adding that Ethereum's price is even more astronomical as the bubble graph outstrips Bitcoin for these levels. And so what we're looking at here are normalization levels of the NASDAQ, S&P 500, Topix, Bitcoin, tulip prices compared to each other in the years around their respective peak bubbles. And so what we could see what essentially look like flat lines from the NASDAQ and the S&P. We could see tulip going up. We could see Bitcoin going up. And then down here as well, we can see Ethereum going up. And so from my technological perspective, when I look at this information, what I'm seeing here is that they're comparing apples and oranges. They're comparing two things that are really not connected. This is like comparing Amazon and Apple stock and Yahoo stock and AOL stock with internet stock. And internet didn't have a stock because internet was a technology, it was a protocol. It was something that existed everywhere that nobody owned. It was a public utility, not a company, not a corporation. It had its own value based on the square of the number of users who were using the internet. And so when you look at NASDAQ, S&P, Topix, and even in the case of the tulips under that scenario, those were markets. They were commodities markets, they were stock markets, they were risky markets that were betting on the future. And with these markets, they go up and they go down. And at some point, these markets have bubbles. So Bitcoin is also a market. It also has a marketplace. But more importantly, people need to realize that Bitcoin is not a company. It's a technology. It's an infrastructure. It is a protocol that is open source, that is decentralized, that is a public service, which anybody in the world can use, can tap into, can leverage. And so when you think about markets, markets are usually thought about in terms of bell graphs, where it goes up and then it goes down, right? But technologies are usually looked at in terms of S-curves, the adoption rate, where it goes up and then it goes up some more. And after reaching a higher level of market penetration, it may then later tail off, right? So you can think about the number of cell phone users in the world. That has grown exponentially over time, and there's fewer and fewer people who don't have cell phones on the way to 100% of everybody having cell phones. The same thing with internet usage. Right now, not everybody can use the internet, but internet adoption is still increasing, and at some point, there will be more and more people who are using the internet. It's an S-curve increasing of adoption. And what I think that we're seeing, in my opinion, is a S-curve of Bitcoin, an S-curve of blockchain, an S-curve in Ethereum, because right now there's less than 1% penetration of the world into this industry, and we could reach 10%, we could reach 20%, we could reach 50% of the world who is using Bitcoin and blockchain technology. And once you square 1 million people, or let's say once you square 1% of the world, and you look at that value, well, if you square 10% of the world, it's much, much greater. And so the article goes on to say, when considering the impact of a cryptocurrency bubble burst, she suggested that it wouldn't lead to a global financial crisis, as cryptocurrencies make up a smaller part of the global economy than previous bubbles do. And so she's suggesting that it's not going to lead to a global financial crisis. She doesn't want to raise alarm bells, especially compared to the fire that is already happening where there's all of this economic smoke. But she's saying when the bubble does burst, some people will get hurt because it's a very, very small part of the global GDP, and people are part of that global GDP. Some companies are going to be affected by that global GDP. I think you would think microchip makers. But what if there's a crash, and what if it's more than 1% of the GDP? What if it coincides with other parts of the economy that are also under a huge amount of stress? What if it becomes more than 1%? And at the same time, the stock market crashes. We see the crypto market crash, which is something that we've seen on February 5th, 2018, the stock market going down the same time as the cryptocurrency going down, market industry overall, which shows that there is not necessarily an inverse correlation between the Bitcoin market and the stock market, because there's not wide enough penetration of people buying into Bitcoin and holding Bitcoin. There's a lot of institutional investors who are still buying Bitcoin, who are still controlling that price with those swings. And if this continues to happen and more of this institutional money comes into Bitcoin, then they're going to have more power to bring the price way up and to bring the price way down as they put their money into Bitcoin and then pull it back out. Now, if people are holding on to Bitcoin and they sell when it's low and then they buy when it's high, well, that's how all of those traders make Lambos, and it's how you lose your holdings in these digital assets. Trading is really risky, it's widely volatile, and traders love it because that's how they make profits. But this is also how the institutional investors make profits and allow themselves to throw their weight around to get cheap Bitcoin prices. And so we all need to just recognize that this is a market. The prices go up, the prices go down. It could go up, it could go down, it could go to zero, it could go to the moon. We are recognizing that these investment chiefs are putting this writing on the wall and waiting to see what will happen next. Separately, coming out of the express.co.uk, we see Deutsche Bank crisis, where the German giant has posted a $1.9 billion euro loss, about 2.7 billion US dollars, and they're blaming the US tax reforms for these losses. As we said in the opening, this is making it the third consecutive annual loss for Deutsche Bank, one of the largest banks in the world, not able to make money, losing 1.2 billion euros due to this tax adjustment in the deferred tax assets in the US tax reform. Well, that $1.2 billion surely doesn't cover the 1.9 billion loss overall. So they're still losing hundreds and hundreds of millions of dollars year after year. And so there's a lot of concern here in 2018 because of everything that happened in 2008, 2009, 2010 with the world banking crisis, the world housing crisis. And so Deutsche Bank is here quoted saying, "We believe we are firmly on the path of producing growth and higher returns with sustained discipline on costs and risks." Not sure what that means. There's a lot of risk happening with all the derivatives, a lot of risk happening with the inflation of money. It's not making anyone feel better. And as a result of the United Kingdom exiting the European Union, well, what's happening is that European banks and the European Union are going to be conducting this banking stress test. And so the European Banking Authority, the EBA, on Wednesday unveiled the scenarios against which the 48 of the largest banks across the 28-member bloc will be tested. And these results are going to be published by early November. It'll be really interesting to see what sort of news happens around that time to coincide with what this test learns. So I really hope that all these banks pass this test. I really hope that they're able to respond to all sorts of market conditions, variables like financial crashes, changes in government, and tectonic shifts in global powers associated with China's rise. We have Russia releasing new capabilities in video with new missiles, nuclear missiles that are able to reach anywhere in the world. We see rising tensions around the world. We see rising tensions against the US petrodollar. And so there's a huge risk for the banks to be able to prove that they can respond to these scenarios, because if these banks can't respond to these scenarios, then it's going to be very clear that the emperor has no clothes. It's going to be very clear that people will lose faith in that system. We may see more people shift to crypto, and wow, let me tell you, this is a tangled web we weave. So this article goes on to state that a savage economic downturn could lead to a 3.3% rise in unemployment, and with approximately 333.8 million working age residents in the EU, including the United Kingdom, based in Eurostat figures from 2014, job losses could feasibly run into the millions. Millions and millions of people across Europe with no jobs. And this whole exact same scenario could 100% be applied to America. Could American banks pass this stress test? Are they going to require a new bailout from the United States government? What would that do to the value of the money after the value of the money already being deteriorated so much since 2010, the TARP bailout, and really since the Federal Reserve was created in 1933? Okay, so let's turn to Twitter. Maybe we got some better news in Twitter. What's Trace Mayer saying? Bitcoin's risk adjustment returns have outperformed stocks and commodities. So Trace Mayer goes on to say, am I a broken record? Repricing humanity's assumption on the risk-free rate of return, the asset with the lowest risk profile is the BTC killer app and primary network effect. And so we have this great credit contradiction where Trace Mayer says the system does not collapse but evaporate, because the very top of the system we have all of this debt, $1.6 trillion in debt. It's a lot of debt. Then and then with power money at the very bottom of this, gold and silver, total world GDP 55 trillion. Doesn't exactly match up with what we were seeing a second ago, but we do know that the derivatives are a lot more than what we can call real money in the world. So what's Randy Woodward say? Global debt 2007, 57 trillion. Global debt 2017, 233 trillion. So in 10 years, this has 5x'd, and he says that's a lot of kindling. That's a lot of material, combustible material, which could get set on fire and could cause for an even greater fire as it affects all of these other aspects in the economy all the way down. All of this debt is a huge concern. All of this printing of money is a huge concern. It makes things easier in the short term, but down the road, people are really wondering how this is going to play out and how is this debt going to go down? Is it going to, as Trace Mayer says, collapse, or is it going to completely evaporate and restructure upon a new primary network effect? All right, what's Charlie Shrem says? The U.S. is about to print more money in the next 2 years than we've ever printed in the history of the world. That's a lot of capital. We're about to spend more money and take on more debt than we've ever done. Hashtag Bitcoin, hashtag building a better system. People are really concerned about how much money is being printed, especially with the new tax cuts that the U.S. has just enacted, the new tax cuts that a lot of people have been happy about because they make billions of dollars or millions and millions of dollars and they're going to receive some tax breaks. Well, at the same time, a lot of people are concerned that it's not going to stimulate the economy, that it's going to create a lot of debt, that that debt is people are going to have a hard time paying back that debt because the economy isn't going to grow as fast as that debt is going to have to get paid back by. And so if that debt has to get paid back and all this new money is being printed and then that increases the inflation rate, your cup of coffee goes from being a couple bucks to 10 bucks. That creates a lot of concern. Interest rates could be increased by the Federal Reserve. If interest rates are increased, then it's going to cost a lot more money for people to borrow money. And it really, sets this whole system on fire. Not that I'm an economist, this is not financial advice, this is just speculation and my own personal opinion, but we do see a lot of debt being created, and in the system, the math just doesn't add up. It just is mind-blowing. So we'll leave this link in the show notes for you as well. You can take a peek at the 28 countries that have experienced mass hyperinflation in just the past 25 years. And so from the beginning of 1990, hyperinflation has occurred in 28 countries around the world with a total of 35 different occasions, of which 17 occurred in 1992 alone. And we'll leave this link for you in the show notes as well, the failure of fiat currencies from the Gold Telegraph. We have the gold versus the US dollar, and we can see how gold has lost 97% of its value since the establishment of the Federal Reserve in 1913. And so this green line is the value of the dollar going down, down, down. And then we have the value of gold relatively going up. How much lower can fiat get? Currently, besides Bitcoin, there's no country in the world, no currency in the world that is based on gold. All money in the world is based on fiat, and Bitcoin is really the only exception, and the only reason it exists is because it's a decentralized open source protocol network technology that simply can't be turned off. It can't be shut down. This is something that exists. It's something that will continue to exist. And even if the internet was to come down, the Bitcoin network could come right back up with it. There's all sorts of ways to try to disrupt Bitcoin. There's a lot of people who are working on this to keep Bitcoin resilient forever. But we don't know how this is going to go. We don't know how this is going to play out. We know that the risk of Bitcoin going to zero is currently about $10,000 or $11,000. We know the risk of Bitcoin going up is infinity because there's never going to be more than 21 million Bitcoins, and the upward pressure for Bitcoin to increase could go as high as all the money in the world. As the demand for these blockchain technologies may increase, the supply is limited. And so if the supply is limited or decreasing and the demand stays the same or increases, then we could see a lot of pressure on the Bitcoin price to move up with that. So I'd love to know what you think. Do you think that there's going to be a Bitcoin crash? Do you think we're in a Bitcoin bubble? Do you think the whales are going to influence the price of Bitcoin up at the same time that the economy is about to go down? And then when the economy goes down, if the economy goes down, do you speculate that the price of Bitcoin will go down with the economy, or do you expect the price of Bitcoin will go up inverse to a falling economy? It's really interesting to see once this starts happening, will people start giving the blame game? Where will the shift be focused? Where will the attention be focused onto away from other situations which are on fire? Are people going to say that there's smoke on Bitcoin? I don't know. But I would love to know, what do you think? I love having you here. I love your support. It's awesome for me. It's awesome for you. It's really awesome that all of us are able to receive this information, talk about this information, have a conversation, share with other people. I wouldn't be here without you. We are not a profitable station. We are really doing this because this information is important for everyone to learn about, for everybody to know about. And I'm really just humbled that you are taking the time to share this information with me. And if you're at the end of this video, then it goes double for you. So with all that being said, thanks for showing up. Thanks for being here. Hit that like button. Let me know what you think in the show notes below. And until next time, I'm glad that together we are minting coins.